All right, so let's look at another exercise on reconciling changes in balance sheet accounts. We've done one like this previously, but doesn't hurt to have a couple out there just in case the other one, for whatever reason, is difficult to find. Okay, so we're dealing with Walgreen Company, and we have some information, some selected information from the balance sheet for years 2013 and 2014, and then also some selected income statement data. Don't have everything, but we won't need everything because we're only being asked a handful of items. So these are fairly tricky, and when we're reconciling changes, there's a couple things I would say. Number one, there's a formula for how to do this. But I would encourage you not to get too wrapped up in formulas. And I would encourage you to read your textbook resources and make sure that you understand why the formulas that we're going to be looking at are accurate, why we want to use those. Okay, we can find the answer easy enough, but we need to be able to put it together in our heads, and that's something that unfortunately largely falls on you. Okay, so requirement A here says compute the cash paid for merchandise inventories in 2014, and assume that, this is important, assume that trade accounts payable is only for merchandise purchases. Well, if it was not, I don't know how we would be able to answer the question. So what we want to do is we want to take as our starting point cost of goods sold, $258,460. Okay? All right. And then we have to say, okay, well, we have to realize that just because we sold this merchandise, we had $258,460 in cost of goods sold, sure, most of that is going to be from purchases that we made during the year of, in this case, 2014. But not all of it. Particularly some of the merchandise that was sold in the first few months of the year was likely purchased in 2013. So we have to assess our increase or decrease in inventories. Okay, and so what we're going to do is we're going to use first the current year ending inventory, and we're going to subtract from that the prior year ending inventory. All right. So we have to include inventory figures because, again, when we think about dollars, sure, we might turn our inventory over a number of times, but we still have the pluses and minuses that we used. We've got inventory purchases that were made in two different periods, 2013 and 2014. So we're going to do that. Then we're going to look at trade accounts payable. We're going to go the opposite direction, because we're going to look at whether or not we overall paid down our short-term debt to our vendors, or whether we increased it. So we're going to actually start with the 2013 figure here, 22,925, and then we're going to say minus 24,050. Okay. So we can use our calculator right here, and we can say, okay, 40,220 minus 36,980 equals 3,240. And we're going to enter that as a positive number because it is. And then we're going to do the same thing for our trade accounts payable, but we're going to start over here in 2013, 22,925 minus 24,050 equals a negative 1,125. Okay? So I'm going to clear this out so that I can start from over here, and I'm going to say now 258,460 cost of goods sold is our starting place, plus 3,240, and then I'm going to say minus 11, let's see, what was that, 25 gives me 260,575. Okay, that's my answer, and that's probably the hardest one that we're going to do. Requirement B says that they want us to compute the net cost of property acquired in 2014. All right, so here's the thing. We don't, all we've been given here for property and equipment on the balance sheet is the accumulated depreciation figure. And then on the income statement, we do have depreciation expense. But what we want to understand is there's a way that we can do this. If depreciation expense was 4,045, and then our net change between 2013 accumulated depreciation and 2014 accumulated depreciation was 4045, we probably didn't have any, well, probably is the key word, didn't have any new acquisitions. But our question says compute the net cost of property acquired. Well, it looks like, because just visually looking at this, we can see that accumulated depreciation it's higher in 2013, but not by 4,045. So we have to do a little bit of a workaround here, because not only have we acquired some property, we've also had some dispositions or some sales. So the formula for this is real simple. We're going to take our depreciation expense as our starting point, and that figure is 4,045. We don't have to do it this way, but that's how I'm going to do it. And then we're going to add to that the difference between accumulated depreciation for 2014 minus where we started off, basically on the first day of the year. And if we think about it like this, we can actually come up with the net cost of property acquired in 2014. So I'm going to take 4,045 in depreciation expense. And I put this in brackets, but I'm just going to, since this is all addition and subtraction, I'm just going to go straight across, plus 57,630. Whoops. 57,630, and then minus the 55,920 beginning balance in accumulated depreciation, and we come up with $5,755 as the net cost of property acquired in 2014. So kind of a nice little trick there. And then the last thing that we're going to do in this exercise is they want us to compute cash dividends paid in 2014. So we can do this a number of ways, but what we will do is we say, okay, were there any dividends paid? Well, we can look at net earnings, and if, just visually, we got 13,570. Look over here at retained earnings. Remember, net earnings flows into the statement of retained earnings or statement of stockholders' equity. And then we remove, or we subtract from this figure any dividends that are paid out. And then the remaining, whatever's left of this, flows to the balance sheet into net earnings. Into retained earnings. So just looking at this spread here, we can see that retained earnings went up, but 94 minus roughly 84 is about 10. So we know that dividends were paid out. Okay, so we can start with our net earnings of 13,570. But now we're going to subtract out the change. So 94,385 is our ending retained earnings, and we're going to subtract from that our beginning retained earnings of 84,240, and that will give us some number. So we've got 13,570 net earnings. Okay, and we're going to say, let's see here, how should we do this? I'm going to actually go ahead and solve this first, so I don't want to confuse anybody. 94,385 minus 84,240 gives us 10,145. I think this will make for a cleaner example. Okay, so now it's very simple. We just take 13,570 net earnings for the period and subtract out the increase to retained earnings of 10,145. Whoops, 10,145, and we come up with $3,425, and that is the amount that was paid out in dividends during the year. All right, that's it for this video.